All right, folks, not sure what happened there. I touched the camera and it didn't like what I did. All right, so anyway, we're talking about these two different methods. One of them, percentage of credit sales, simpler to apply. The other one is aging of accounts receivable. Now, what I was mentioning, not sure if it got on the tape or not, but what I was mentioning is that the longer somebody owes you money for, the less likely you are to get it. So for example, let's say you loan a friend of yours 20 bucks, right? I'll give it to you this Friday. This Friday comes, you don't get it. You mention it to them again later on. The next Friday, you still don't have it. The next Friday, so just like with your friend, the longer it is that they go without paying you back, the less likely you are to see that money. Same thing for business, okay? So what is a more accurate way of estimating DBX? By the way, DBX, this right here, DBX, this is bad debt expense. It's an abbreviation for bad debt expense, okay? Just to let you know, all right? What's the more accurate method? Which one is more accurate, okay? So notice for the first one, we'll talk about credit sales method. The percentage of credit sales you estimates bad debt expense by multiplying a historical percentage of bad debt losses. So like here, you take $120,000. That's their credit sales for the month, and their bad debt rate, by the way, less than 1%, right? So notice here, 900 bucks. So actually, it's pretty good. Less than 1% goes bad. Okay, so there you go. So they expect, out of that 120,000, they expect to collect $119,100. Okay, all right. So 0.75%, that's their bad debt expense for this month. And there you go. That's the journal entry based upon that. So there you go, bad debt expense. It's an expense account. We're debiting it to increase it. And then we're opening up that allowance. We're adding it to the allowance for doubtful accounts. We're adding $900, putting that money in the cookie jar, okay? By the way, they call that method the income statement approach, okay? Because it's based off of an income statement number, okay? Now, the accounts receivable method, the next method we're going to look at, focuses on the ending balance of allowance for doubtful accounts. It's called the balance sheet approach. By the way, it's more complicated, but the aging process lets you take a look at the different time frames for your accounts receivable, because the different time frames had different meaning. Like I said, the longer somebody owes you money, so it's actually a more accurate method, okay? All right, so here you go. So step one, what we're going to do. So if you take a look, they have all of these customers right here, right? They have all these customers, and there's 0 to 30 days, 31 to 60, 61 to 90, over 90, okay? So what they do, and then they estimate, they put a percentage in for each one, okay? So the first thing we do is we divide it by how old is it, okay? So we prepare the list. Oh, let's go back. Come on now. Where's my highlighter? We prepare the list, right? We get our debt loss percentages. Those are usually pretty common for each, like they're pretty consistent. And then compute the total estimated amount, okay? So here we go. So for example, between 0 and 30, they estimate only 1%. From 31 to 60 days, 10%. 61 to 90, 20%. Over 90, 40%. So they think anything over 90 days, 40% of it they're never going to collect, okay? So what they do is they multiply all these out, okay? And come on now. As you can see here, total accounts receivable is 208,000, right? And when you tally all of these up, these numbers right here, they estimate that this is the total amount of that 208,000. 15,500 they estimate is uncollectible, but notice they estimate different percentages based upon the age, okay? And they do this based upon experience, okay? Then what they do is they make the bad debt expense equal that amount, that allowance equal that amount. So for example, here's an example. This is the allowance, right? So they just calculated $15,500. This is the desired balance. So if you currently have $14,200 in there, you have to add an adjusting journal entry of $1,300 to bring it to that amount. So with this method, what you do is you'll bring it to the amount that it's intended to be, okay? So, as a general rule, question number 6, don't forget to write it down because it's going to be on your quiz. Which of the following would have a higher percentage of uncollectible accounts? Less than 30 days, 31 to 60, 60 to 90, okay? Which one would have the highest percentage, okay? And nothing for D. Looks like I forgot to put one in there, okay? All right, so now we're using the aging method. So notice what we're gonna do. We're gonna put $1,300 in that allowance for doubtful accounts, and we're gonna show bad debt expense of $1,300, okay? And so notice what happens. Here's our allowance. It's a contra asset, so it increases with a credit. Remember, contra meaning opposite. So it increases with a credit. There was our unadjusted balance. We said this is where it needs to be. So we're adding $1,300 to it. Now our bad debt expense, our beginning balance was $900. Now we're doing an adjusting journal entry for $1,300. So now year to date, it's going to be $2,200. Again, it's an expense, so it increases with the debit. Okay. So they were showing you the same company 2 different times. Okay. All right. Now sometimes revising estimates, bad debt expenses usually differ from the amounts that are later written off. So the estimates and what's later written off are not always the same. If the differences are material, companies are required to revise their estimates. Okay. And then they have something called account recoveries, collection of a previously written off account. Okay. So what happens when you write off a customer's account and then somehow you manage to get the money? Okay. Well, the first thing you have to do is put the receivable back on the books because you've taken it off your books. You have to put the company back on the books and then record the collection. Okay. So to let you know, these are estimates, and what a company has to do, they're like, let's say for argument's sake, they say 1%, or they take a look and they say it's either 1% is not going to be collected, or they do the 30, 60, 90, and they come up with a number and they go, wow, we have a lot in the allowance and we're not using it. Well, if you have too much money in your allowance consistently, that means you're overestimating your bad debt expense. You're going to want to change that number to a lower number because you're putting too much money aside. Also, if you put money aside in that allowance account and you're constantly using more than that, then you're going to go, whoa, we have to put more money in there. So again, it's not a perfect system. You have to get it as close as possible, and that's what companies look to do. Okay. Same thing with the recoveries. On occasion, somebody doesn't pay you, and you aren't able to collect the money. But the problem is you took that company off the books. So if they're not on your books, the first thing you have to do is put them back on the books, then show the payment. Okay? So for example, it says, let's assume the VFC collects $800 from fast fashion. It was previously written off. Okay? So the first thing they got to do is put that account receivable back on the books. Right here, back on the books. This is fast fashion. They've taken them off. So what they do, they debit accounts receivable, they put it back, and now they have to put, that $800 they used when they wrote it off, they have to put that back into the cookie jar. Right? We use that money to write off that account, and then it's like, uh-oh, so now they're going to pay. Well, actually, not uh-oh, it's a good thing. They're going to pay us. So now we can put that money back. And then what we do, when they pay us, we increase our cash and we take their account receivable off the books. So you see here, we reverse that write-off. Okay? So again, we took them off, we got to put them back on. All right, folks, it turns out that's part 3 because we had a little short part for part 2. We'll be back to part 4 in just a minute.